Welcome to the current federal tax developments for the week of June the 4th, 2018. Current federal tax developments are brought to you this week, as always, by Kaplan Professional Education and by your state society of CPAs. This week, we're going to look at 4 different developments during the week. We had a short week, so we have a few less developments maybe than we normally discuss. We're going to first look at a fact sheet the IRS issued that tells us how the IRS contacts taxpayers and how it doesn't. The IRS issued a ruling that outlined how a taxpayer, let's say a custodian who's holding IRA funds for a taxpayer, has to deal with a situation when they have to turn the funds over to the state under an abandoned property statute. In the third development, we're going to take a look at a case where a taxpayer was found to be a statutory employee, and because of that was able to claim deductions above the line, an issue that will become even more important for us this year due to the changes made in the Tax Cuts and Jobs Act. And finally, we're going to discuss the IRS's proposed regulations that would expand the number of taxpayers who have to file all of their information returns via electronic means rather than being able to file some on paper. Well, let's start out this week and take a look first at the IRS's special fact sheet they issued on contacting taxpayers. This is fact sheet FS 2018-12. It was issued on May the 31st of 2018. And it starts out by listing ways that the IRS will contact taxpayers. Now, it tells us things like, the IRS will normally contact taxpayers, by phone, or, they won't normally contact them by phone or visit the taxpayer's home, at least not as initial contact. But there are some cases, for instance, if a taxpayer has an overdue tax bill, to secure a delinquent tax return or delinquent employment tax payment, or to tour a business as part of an exam. They note that even in those cases, normally a taxpayer will get a letter ahead of time. Well, as you might guess, that had enough qualifiers in it that it's not the most, shall we say, rock solid, assurance that somebody would have that this, call they're getting on the phone was not actually the IRS, or this guy that showed up at the door is not the IRS. But they do go on and tell us some things the IRS would never do. One of the things the IRS would never do is demand that people use a specific payment method, especially things like a prepaid debit card or gift card or wire transfer. Those are sorts of things that a fraudster will ask for because that makes it a lot easier for them to deal with the cash. And they talk about the ways you should pay the IRS. They will never demand immediate tax payment. The correspondence will be a letter in the mail. You can appeal. You can question what they owe. Of course, if a taxpayer has ignored notices for quite a while, we may be past that point. So unfortunately, that's not terribly helpful. But if they've had no notice ahead of time, you can point that out to them. And they also say that they're going to threaten to bring in local police, immigration officers, or other law enforcement agencies to arrest people for not paying. They remind you that the IRS cannot revoke a license, like your taxpayer may be told that, oh yeah, your license to do business will be revoked unless you pay your tax bill. They may also tell us that we may revoke your immigration status if you don't pay your tax bill. They said these sorts of tactics are very common and normally used by the fraudsters. In fact, quite often they threaten to call the local police on the person on the phone to try to get them to pay up right away without actually worrying about whether they owe the money. Okay. Now, as I said, the hitch is this may be a confusing list for the taxpayer if they've not yet been contacted. In fact, that's probably the issue. So I'm not sure I would send it to everybody. However, the fact that it tells you how they work and especially the things they won't do can be very useful to reassure those taxpayers, and we all get them on the line, that have just gotten a call and, don't know. And how do I know it's not the IRS, and what, you can give them this documentation. It helps show them, and it's always useful to have something with IRS letterhead that you can show them that the IRS will not be the person calling and demanding that they make a payment on a debit card or do various other things that this person is doing, with them. The thing I always tell them too is, just call the IRS at the number in their phone book. Well, assuming they can find a phone book these days, or on the website, give them the number to call and say, you know what, if you really owe the IRS this much money, they'll look up your account. They'll know you owe them this much money. So that won't really be a major problem to find out. By the way, that's good advice I've found for all people that call for fraud lines from anything. If you really owe Citibank that much money, if you call Citibank with your account information, they'll probably tell you that you owe them that much money, or they'll tell you that, no, we never called you. And unfortunately, these days, all too often, no, we never called you or no, we never emailed you will generally be the answer. Next up, the IRS issued a new revenue ruling this week, Revenue Ruling 2018-17, issued on May the 29th. This revenue ruling deals with state abandoned property statutes. Most states have a statute that says, essentially, if you're holding funds or certain other property that for someone else, and that someone else essentially becomes lost or doesn't contact you for a certain period of time, that's deemed to be abandoned property. And you can't just keep the abandoned property. You rather are supposed to turn that property over to the state agency that handles abandoned property. In many states, it's a revenue department or something associated with the revenue department that will handle the abandoned property accounts. Now, the hitch becomes, what if that property is an IRA account and you're an IRA custodian? Well, this also has an impact, to be totally honest, on the person whose property has been abandoned, and not just in the case that, well, it's being turned over to the state, because that normally, if you go through the proper mechanism, you can recover. What the states know is a lot of people never go through that mechanism, so they make some decent money off abandoned property. But as a custodian, you've got a problem because the state of Arizona, the state of New Hampshire, the state of Idaho, they're not IRA custodians. So you're going to be transferring IRA funds to an entity not eligible to hold the funds in any way that has no agreement with the taxpayer to hold IRA funds. So the catch is, that's a distribution, isn't it? The IRS, therefore, came up with this ruling. Because if it's a distribution, don't we have to worry about the withholding election? And secondly, don't we need to issue a 1099-R to the person whose account it is? By the way, which is probably going to be sent to an address that's going to come back to us, because that's the reason why we still have it as abandoned property, because we've never been able to contact them due to the fact that, we don't have their we don't have the proper address. Well, what the IRS rules in this case is interesting enough. They talk about the fact that IRA funds, generally when you take a distribution from an IRA, the person taking the distribution is asked, do you want to have funds withheld? Well, basically, Section 3405 provides that generally there will be withholding, that is at 10%, on distributions from an IRA. However, that same provision allows a taxpayer to elect out, to opt out of withholding. Now, quite often it's not obvious that way. What's going to happen is you'll go to the website maybe to ask for a distribution from the IRA. The fund will say, well, fine, here's your distribution. Do you want to have funds withheld, or do you elect not to have them withheld? And you say, I elect not to, right? But you always have to make that choice, because if no choice is made, you have to withhold. The IRS said, well, in this case, no choice has been made. And that's almost certainly true. It's rare that anybody makes an election ahead and says, yeah, when you abandon that property to the state, I've elected not to have anything withheld. That doesn't usually happen. So essentially, the custodian is going to have to withhold on a transfer. As well, the IRS holds in this revenue ruling, the custodian is going to have to issue a Form 1099-R. Now, again, that problem's going to be with that is it's going to go to the address, which we know is the wrong address, but it's the last one we've got. But it will also go to the IRS. That means very likely taxpayers will discover about these IRA funds that have been moved to the state at the time they get the CP 2000 notice that tells them, oh, by the way, you also owe tax on this distribution. Good news, we got 10%. Bad news, it was an early distribution, so the 10% just covers that. And number two, yeah, you're in the whatever percent tax bracket. So in addition, you owe all this money on that account that was transferred over. One thing to remember always about these abandoned property statutes, even not for IRA custodians, is these things usually cover lots of items, including, for instance, if you have any accounts receivable where the customer has overpaid and you can't return that overpayment to the customer, technically that's got to go back to the state. eventually. So yeah, we always want to watch that. States are known times if they believe they're going to make money doing it. They've been known to go into businesses to look for compliance with the abandoned property rules. Next up, we have our one court case of this week. And this gentleman, I am going to really clobber his name, but Fizusko, well, we hope, whatever his name, versus Commissioner, Tax TC Memorandum 2018-75 issued on May 31st. By the way, how you spell that guy's name is Fieddziuszko. So if you're looking it up, that's how you spell it. I'd basically just go get our information from the website and get the case from there. But if you're going to look for the case, or just look for TC Memo 2018-75. But this is the case in question. This involves the issue of a taxpayer that worked with an organization for 2 years. And the first year, the 1099 or the W-2 came out to him, and it had the box check that he was a statutory employee. In year number 2, it did not have the box check that he's a statutory employee. Now, let's discuss what in the world is a statutory employee. Well, an employee for withholding purposes and FICA purposes generally is defined in Section 3121D. And there's a list of 4 different types of things that will make you an employee. The main one that covers most taxpayers is a category called a common law employee. If you're a common law employee, you're an employee. But there's also this category at D3 called a statutory employee. Now, a statutory employee has to meet essentially 3 criterions, okay? First, simple criterion. You cannot be a common law employee. So effectively, you cannot be a common law employee. So bottom line, that's your first starting. We're not a common law employee. Number 2, you have to be in one of 4 categories. You have to be an agent driver or commission driver if for specific products. You have to be a full-time life insurance salesman. You have to be a home worker performing certain work, or you have to be a traveling or city salesman who also meets certain criteria. Okay. Finally, you got to meet a criteria found at the end of Section 3121D that says the contract of service contemplates substantially all the services are to be performed personally by the individual, except an individual shall not be included in the term employee under the provisions of this paragraph if an individual has substantial investment in facilities and in connection with performance of such services other than in facilities for transportation, or if these services are in the nature of a single transaction, not part of a continuing relationship with the person for whom the services are performed. So if you meet all that criteria, you will get a W-2, but you're in this odd category called a statutory employee. Why is that important? Well, Revenue Ruling 90-93, the IRS noted that a statutory employee by definition is not a common law employee. Why is that important? Code Section 62 provides generally that business deductions cannot be claimed by an employee in computing adjusted gross income. Rather, they are miscellaneous itemized deductions. For the years in question for this gentleman, that would have made them subject to the 2% haircut and not deductible for AMT. Note, for 2018, it would make them just not deductible, period. But the IRS notes that they just use the term employee. In this Revenue Ruling 90-93, the IRS concludes that those sections do not include statutory employees in their definition of employee. So a statutory employee is able to claim the deductions related to their employment above the line on Schedule C. That can be very, very helpful because obviously above the line meant no haircut. In 2018, above the line means that the taxpayer is not going to have to worry about the fact they won't get any benefit for the deductions. So one key catch is, as you may be aware, it's going to be very important to recognize if you have a statutory employee or not. Well, what was the issue here? Well, in this case, we said the court had the following facts. This gentleman was a retired engineer, worked as a consultant for basically Space Systems Loral. And he found his work by attending conferences, traveling to visit potential clients. He entered a contract to provide his consulting to an entity through West Valley Engineering Company, which is a temporary employment agency that Loral used to hire its consultants. He had a contract that began in 2011, ended in July 2012. He did work primarily from home on a satellite development project. He produced reports and components for Loral. West Valley made weekly deposits into his checking account. It was under the entry West Valley Engineering Payroll. Included a date that was 2 days before the actual deposits, last 4 digits of his social. The deposit made on, they said they took a date here, January 31st, 2012, included a date 12/01/11. And most weeks the deposit was $2,649. Sometimes there were variations. Last deposit came in August of 2012. West Valley processed the pay for the work for Loral, withheld federal income tax as well as Social Security and Medicare tax. West Valley didn't offer him any medical or dental insurance, paid vacation leave or reimbursement of his expenses, did offer a deferred compensation plan. On the 2011 return, it marked him as a statutory employee. And on 2012, it did not. Not surprisingly, the IRS, of course, challenged the taxpayers' treatment of that as a above-the-line deduction back in 2012, saying, your W-2 doesn't say that. And the taxpayer said, well, that's just a mistake in how West Valley prepared the W-2. In reality, we were a statutory employee for both years. The tax court pretty much agreed that he had to be either he was or he wasn't for both years. It's not one of those things where anything changed between 11 and 12 that would magically make him into not a statutory employee when the year before he had been. So they began looking at his background. Now, the taxpayer was doing the homework that's described in Section 3121 D3C. He met all the requirements of that one. By the way, I kind of suggest you go back and review all those categories because it's really important, especially in 2018, to recognize whether you got a client in any of those categories. But the issue then became, was he a common law employee of West Valley? Because remember, if you're a common law employee, it doesn't matter if you're in one of the categories, okay? And in that case, if you're a common law employee, those deductions became miscellaneous itemized, or in 2018, become just totally non-deductible. Well, the court looked at the record and decided, in this case, he's not a common law employee. W-2 obviously said he wasn't a common law employee, but they said that's a mistake. 2011 made clear it was. Nothing changed. He worked primarily from his home office rather than Loral's offices. He produced reports and patents according to his assignments for Loral. Didn't change. They both include independent consulting arrangement rather than being a common law employee. He advertised his services to several other companies, was hired through a temporary employment agency. That was a temporary relationship that terminated in 2012. The record, as I said, all the IRS really had to suggest he wasn't a statutory employee was information that was totally consistent with an error by West Valley. The weekly payroll deposits, payroll taxing, withholding federal state income taxes, Social Security medical taxes from him are consistent with the consulting contract for services. So we conclude, the court said, that the totality of the circumstances indicate that he was a statutory employee. Therefore, he's allowed to deduct his business income and expenses, report business income and expenses on Schedule C of Form 1040, and does not have to worry about losing a deduction or having it reduced by being on Schedule A. As noted, the big takeaway from this one this year is that in 2018, this becomes a much, much, much bigger problem. So again, if you're not used to this, again, it's one of those things where you're not going to see a ton of statutory employees, but you probably want to be aware of what one is if you do any individual return work for anybody who is an employee. Because again, this year, the only way a lot of these people are going to get any benefit is if you somehow find a way they're not. Now, that said, please don't go trying to make everyone a statutory employee. The category is narrow. You want to check the case law and you want to be careful before you do it. But you also want to make sure you don't miss the fact that somebody is one. The final issue this week comes in the form of proposed regulations. These are Regs 102-951-16, 83 in the Federal Reserve, page 24948 to 24950. They were published on May the 30th. These regs, now normally I don't cover a lot of proposed regs. There's only certain cases where I do because obviously they're proposed regs and they may change and the final regs are what's going to govern things. So, at a reg like this is not really anything you could rely upon before it's finally published. So why are we looking at these? Well, we're looking at these because of the proposed effective date means that you probably better start at least preparing to have to comply with them, because the next time you file information returns, most likely these regs or something very close to them are going to be in place. These regulations would change the requirement for electronically filing information returns. Under current law, you count each separate type of information return. You look at the number of forms you file. So let's say you file 200 W-2s and you file 100 Form 1099 miscellaneouses. Well, the current law says you have to file more, if you have to electronically file, if you file more than 250 returns. But you treat each category separately. There's no aggregation of categories. Under the new regulations, we would aggregate before we did the 250 test. So under the old law, 200 W-2s, no need to e-file W-2s. 100 1099 miscellaneouses, no need to file 1099 miscellaneouses. Let's even say they file 2 1099 interest forms. No need to file those either. They're below 250. Now we come to the current law. Under the proposed regs, we would add them together and decide if we can go over 250. In this case, even though we only have 200 W-2s, since we have 352 information returns in total, the W-2s must be e-filed, as must the 1099 miscellaneouses, and even those 2 1099 interest forms have to be electronically filed. Now, we've already seen some comments come in from various sources on this issue, saying that this is going to impose a greater burden on small businesses. As one accountant has pointed out that I saw post on the Arizona Society listserv, a lot of taxpayers, they may be electronically filing W-2s. They use a payroll service for that, but they've always filed their own 1099s because they only do, maybe they file, and this is true of a lot of small clients. You may have 300 employees, but you might only issue 5 1099 miscellaneouses. You issue them to the attorney, you issue them to whoever you pay rent to. You might pay a 1099 interest because you have a loan. You have amounts that you borrowed from the officer, so you have to issue a 1099 int, that one. So, we have all the W-2s taken care of by Paychex, ADP, whoever, but we don't really have anybody who's taking care of the 1099s. We're doing it. Now those businesses will have to go out and find somebody to file those handful of 1099s because they have more than enough W-2s as well. The Paychex and ADPs of the world, well, assuming they would consider paper filing, which they probably never would. But if they were going to try to paper file, payroll service wanted to paper file, they would have to confirm that the customer is not actually having to file 1099s. That will be enough to push them over the 250 limit. Obviously, the IRS's point in this is to save them money and get to a common processing system. Originally, the IRS justified counting each one separately, saying that was done intentionally to reduce the amount of cost and complexity that might be involved as companies transition to this. The IRS apparently has now decided that computers have become ubiquitous. People have these things, they're doing everything. A whole lot of people are voluntarily filing these forms electronically. So the IRS has decided it would not be a significant burden to have to require every business to file all such forms electronically. Now, here's the caveat. If you have examples of clients, or if your business is one, where it's going to be a major problem because you have to try to e-file these few 1099s you have to file, or maybe a few W-2s. I don't know what your issue is, but there's something you have to e-file. You might want to send comments in during the comment period that's now open. You can send those comments in on this reg. You can find it on the Federal Register, tell you where to send those comments to. You probably want to go ahead and get that in and try to become issue comments to at least suggest certain things. Like one comment suggested by that poster on the Arizona listserv was, maybe we should have separate rules. W-2 should be a separate category from 1099s because of the differences in the two. That is, if you only go over 250 because of W-2s, then, maybe you can continue filing your 1099s paper. Or maybe, let's say if you file less than 100 1099s, they could still be paper even if you had more than 250 W-2s. Don't know if the IRS would take up that suggestion, but, those are sort of things you send in as suggestions. The big reason why people panic on this one is it would take effect for returns required. Basically, what it says, it would take effect as soon as it is published in the Federal Register, but it would not apply to any information returns required to be filed. Notice it says, I should say, information returns actually filed before January 1st of 2019. That means, of course, since you're going to file 2018 1099s on or after January 1st of 2019, your 2018 information returns will all be covered by this rule. So if you have a client or your own business where you're sitting close, we're looking at 250 where we could add them all up, we go over 250, start realizing that you're going to have to file them all. And if you're one of those businesses that had more than 250 employees, but you don't do many 1099s, you better start figuring out how you're going to get the 1099s filed this year, because those will need to be done electronically. You will not be able to continue to do paper versions of, let's say, that one 1099 interest to the owner for the loan and the 1099 miscellaneous to the attorney for the legal services. You're going to have to electronically file both of those, at least if these regs go through without changes. As I said, this is a time, how we pay the bills here is by doing courses and having you guys come up, and arrive for courses at the state societies. My primary work is at state societies or for in-house courses that are most often booked by state societies. So, I want you to take a look at what we've got available there for you to sign up for. Just this past week, I had a wonderful time with 2 straight days of talking about qualified business income, the old Section 199 Cap A, and other business changes as part of the Tax Cuts and Jobs Act. Had one day here in Phoenix, did immediately the next day in Albuquerque. Those are the sort of courses that you're going to find in your state society catalogs right now. Those are sort of things as well. If you want us to present that information in your firm, we're available to do that too. But go ahead and be sure to try to take a look at what's offered in those live options that your state society has for you. And if you want to see somebody come in and talk to your firm, most often you can contact your state society and they can help arrange to get us into your offices in order to present for you and get you up to speed for your firm or your business to deal with what may be important for you. So make sure you check that out. This has been the Current Federal Tax Developments for the week of June the 4th. You can catch our updates at the website, currentfederaltaxdevelopments.com. You can also send any questions or comments to me, edzollers at currentfederaltaxdevelopments.com. You can follow my Twitter account on Twitter at edzollers. And I also post to discussions on the Reddit subreddit at www.reddit.com/r/taxpros. Just go there and you can talk there. They really moderate that one well to limit the questions there to those from tax pros, because what's going to happen is non-pros are going to sneak in there, want to try to get free advice. They're pretty good at getting rid of those pretty quickly. And again, look forward to seeing you all next week. We'll talk about what comes up in the following week in the area of federal taxes.